All right, now that we're familiar with all the details on the financial statements, there's one last thing that I want to explain to you, and that's the concept of debits and credits. Now, this is a really highly technical accounting concept, which you don't really need to understand in full. Like I spoke about earlier, the more you understand about accounting, the stronger of an FP&A professional you're going to be, and the better your financial models will be. That's because when you create a financial model, you need to understand the impact of your financial statements and which accounts will increase and decrease. And that's exactly what debits and credits are. Debits and credits help communicate which accounts on your income statement and balance sheet can either increase or decrease. Now, they don't need to both increase or both decrease, or one increases and one decreases. There is really any combination that can take place. The general idea is that debits need to equal credits. So anytime a financial activity takes place under double entry accounting, you're always going to have a debit and a credit, which means you'll always have two aspects of your financial statements that are affected. And to be honest, I think most college courses really complicate this concept. It's very easy for you to understand. All you need to memorize is the fact that assets go up with a debit and down with a credit. Now, because we know that assets must go up with a debit and down with a credit, we know that your liabilities and owner's equity, which is on the other side of the accounting equation, needs to behave in the opposite manner. Anytime that you incur a liability, you'll recognize that by recording a credit to that liability for it going up. You'll then debit it whenever the liability goes down. And the same is true for your owner's equity. Remember, if assets equals liabilities plus owner's equity, then however we treat assets for debits and credits is the opposite of how we're going to treat liabilities and owner's equity. So once again, assets go up with a debit and down with a credit. Liabilities and owner's equity behave in the opposite manner. They go up with a credit and down with a debit. Now, think about this. Like we just spoke about in the last video, your net income flows into your balance sheet via retained earnings, which means any time that you're recording income on your income statement, your retained earnings or your equity section on your balance sheet is going to be increasing. Anytime that you're recording expenses on your income statement, that is going to impact your net income with a decrease, which is going to cause your retained earnings and equity balance to go down. So for that reason, the way that we treat our debits and credits on the income statement is very similar. All of our income accounts are going to behave in the same manner that our equity accounts go up and down by. Like we spoke about, equity accounts go up with a credit and down with a debit. So in order to recognize revenue, that is going to cause our revenue to go up with a credit and down with a debit. Any expenses that we have will behave in the opposite way because now you're decreasing your retained earnings. So that will cause you to debit your expenses for them to go up and credit them for them to go down. Now, in reality, on the income statement, revenue doesn't usually go down, nor do expenses. They both usually just go up. But you could technically have a sales refund or an expense refund, which could cause them to ultimately go down. Let's just go over some really quick examples. So like we spoke about, your profit and loss flows into your owner's equity through an account called retained earnings. So retained earnings, the net income over here, all just an accumulation of what happens on your profit and loss. So if you want to record revenue, you'll debit your cash, which is an asset, and you will credit your revenue. That means, absent of anything else, when revenue goes up, cash will go up as well. When you collect cash from accounts receivable, you'll debit that cash and you'll credit the accounts receivable. If you take out a loan, well, your cash is going to go up and so is your debt. So assets go up and liabilities go up. Debit your asset, credit your liability. When you earn revenue from deferred revenue, well, that means that you'll be recording revenue, which we said goes up with a credit. And then your deferred revenue balance will be going down, which is a debit. Go ahead and go through all these other examples on this infographic. Now, you don't need to really go too crazy. Again, many FP&A professionals get by just fine without really understanding debits and credits. But when you understand the nuances, it becomes so much easier to factor in what happens between all the accounts when you're creating your robust financial models.